When you picture a classic sports team owner, you probably think of some local billionaire, right? A super passionate fan, someone whose whole identity is wrapped up in the city and the logo on the jersey. And for decades, that was pretty much the model. But that picture, it's fading fast. Today, there's a new kind of owner in town, an owner who doesn't wear the team colors because they're too busy managing a portfolio. We're going to break down how this massive shift is changing the very games we love.
I mean, look at this contrast. On one side, you got the classic owner. For them, the team was a passion project. It was a kind of civic trust. And the ultimate goal? Winning. Success on the field. But then, on the other side, you have the new owner. The team is now, plain and simple, a financial asset. It's managed for strict return on investment with this laser focus on monetizing everything off the field. This isn't just a small change. It's a fundamental rewiring of what a team is even for. So yeah, what changed? How on earth did we go from local heroes to global hedge funds sitting in the owner's box? Well, as you can probably guess, it wasn't just one thing. This shift is way more than just a change in who's signing the checks. We're talking about a massive structural transformation. Teams are going from being these cherished community institutions to being treated like global financial instruments, managed just like any other asset on Wall Street. And that really gets to the heart of it. What used to be this exclusive, super expensive hobby for the mega rich has now been targeted by private equity and sovereign wealth funds as a brand new place to make a lot of money. The game itself might look the same, but believe me, the business behind it has been completely reinvented. So you have to ask, why did Wall Street suddenly start knocking? Well, it wasn't just that they saw a great opportunity. It was also because the old model of ownership was actually starting to crack under all this new pressure. The leagues themselves kind of had to open the door. Yeah, what the research shows is that this wasn't some random thing. It was a perfect storm. It was this unique combination of really powerful economic forces that created an environment where big money institutional investment wasn't just an option. For a lot of teams, it became absolutely necessary just to stay afloat. You can really break this perfect storm down into what you could call a three-part squeeze. Okay, so first, team valuations just went through the roof. They got so expensive that the number of individual billionaires who could actually afford one just dwindled. Second, investors got obsessed with this idea of sports as a non-correlated asset. And don't worry, we'll explain what that means in just a sec. And third, the huge financial crunch from the pandemic was really the final straw that forced the leagues to let all this new money in. So what in the world is a non-correlated asset? Honestly, it's an investor's dream. It basically means that whether the stock market is soaring or crashing, fans are still going to buy tickets. They're still going to watch the games, and they're still going to buy the jerseys. That incredible loyalty creates this super stable, predictable stream of revenue, which is exactly what big financial firms want to help balance out their riskier bets. Okay, so once private equity got their foot in the door, what do? They didn't just show up to enjoy the games. Oh no, they came with a very specific playbook, one designed to turn a sports team into a high-powered cash flow engine. And this lays out that playbook perfectly. Step 1, squeeze every single drop of value out of media rights and intellectual property. We're talking streaming, data, you name it. Step 2, develop all the real estate around the stadium to create these year-round entertainment hubs. And step 3, which is a huge deal in soccer, is to build these multi-club networks. You can share things like scouting and make player trading way more efficient. What this all means is the focus just explodes way beyond the 81 home games or the 17-week season. The real goal now is to transform a seasonal sports team into a 365-day-a-year entertainment and real estate empire that has a global footprint. But, and this is a really big but, this flood of sophisticated money comes with a cost. It brings a whole new set of rules and new systemic risks that pit the classic goal of winning championships against the cold, hard mandate for return on investment. This quote, wow, it really says everything. A private equity fund has what's called a fiduciary duty. That's a legal obligation to make as much money as possible for its investors. That legal duty is not to the fans, it's not to the city, and it's not even to winning, if winning gets in the way of the bottom line. And that creates this fundamental you can't avoid it tension right at the very heart of the team. And look, this isn't just some philosophical debate. The analysis shows that this new model introduces some profound, real-world structural risks and ethical dilemmas. These are challenges that affect everybody, from the league commissioners in their fancy offices all the way down to the most die-hard season ticket holder. So what's the potential fallout here? Well, first there's the exit conundrum. See, private equity firms have to sell their stake in about 7 to 10 years to cash in. But with valuations just soaring, who's even going to be able to afford to buy the team from them? It's a recipe for instability. Second, competitive balance starts to erode. The money just flows to the big market, famous teams, which makes the gap between the haves and the have-nots even wider. And finally, there's this relentless pressure for short-term profits, which can totally get in the way of smart, patient, long-term team building.
All right, so all of this financial engineering, all this boardroom strategy, it all leads to the most important question of all. What does it mean for the fans? For us? How does it redefine the actual soul of the game we watch from the stands?
The bottom line is this: that unwritten social contract between a team and its community is being changed in a fundamental way. The idea that a team is a public trust, a source of civic pride that belongs to everybody, that idea is being challenged. Sure, this new money brings financial stability in modern stadiums, but it also makes the relationship feel a whole lot more transactional.
Which leaves us with this final, really critical question. This change, it's not going backwards. Wall Street is in the game, and they're here to stay. So as we watch all this unfold, we have to ask ourselves, when your favorite team is treated less like a passion project and more like just another financial instrument, who is the game really for?